Stocks, bonds, and other common investment products are designed with the goal of appreciation over time. However, most have one caveat: they move up and down with the market. Private credit is different. Untethered to the market, private credit seeks to provide both growth and stability, adding a more balanced risk profile to any portfolio. With the potential for low volatility, stable income, and inflation protection, private credit has become one of the fastest growing asset classes. So let's take a closer look at private credit, which you may hear referred to as direct lending, private debt, or private lending. Simply put, private credit is a loan where a bank is not involved as a lender, and the company debt is not publicly issued or traded. Now you're probably thinking, with no bank involved, wouldn't this involve more risk? To the contrary, private credit falls into a broader category of performing credit, where the borrower company is performing their obligations pursuant to the loan agreement. This is opposed to non-performing credit, such as distressed or stressed credit, where the borrower is in default on the terms of the loan agreement. So how can we ensure they're relatively low risk? Well, a key distinction to private credit is a highly selective process that serves to help mitigate risk. Diligent lenders offering private loans invest the time to fully understand a borrower's business and capital needs, and to peel back the complexity within their industry. As you can imagine, sourcing matters, relationships matter, and a lender's deep industry expertise in each particular sector matters. Here's an example. High-growth life science companies might not fit so neatly into a traditional lending box because they reinvest their profits into an ongoing development of life-saving products. This can make them more difficult to value. So, while traditional lenders like banks face increased regulations that make it challenging to structure tailored loans for smaller borrowers, private lenders can offer those companies the flexibility they need to grow their bottom line. Let's simplify private lending into two basic transaction types: sponsored and non-sponsored. Think of sponsored financing as a loan to a private equity-owned or controlled business. That private equity firm acts as a sponsor to help drive the deal forward by virtue of its investment, which could potentially provide a comfortable equity cushion. Non-sponsored financing involves a direct relationship between the borrower and lender. These are often bespoke, proprietary loans with a high-performing company that lacks access to bank financing, such as those high-growth life science firms mentioned earlier. Because of their perceived risk, these lending opportunities may often drive even higher yields, but they typically require long-standing relationships and deeper diligence to execute successfully. Conscientious private lenders will seek to negotiate tight covenants or loan terms with the borrower to help minimize loss. Ideally, the loans are also first lien, senior secured, and floating rate in nature. We believe private credit is an exciting area where insight and due diligence can notably differentiate returns. It's where the right investor can source harder to access areas of the credit market with the greatest potential for attractive returns, where lower volatility, historically stable income, and the floating rate nature of those loans can help minimize the effects of market shifts. Successful private credit investing requires strong sourcing channels, deep relationships, and specialized structuring expertise, all possible in the right hands.